Welcome back. So tax planning is something we talk about a lot here on Retirement News Online. When you get into retirement, many are surprised to find themselves actually in a higher tax bracket. My guest is Darcy Bergen, who practices in Peoria, Arizona. So Darcy, going back to my statement in the beginning, it's probably a surprise to many to find themselves upon retirement that they're in a higher tax bracket. How do you manage that?
Well, it's interesting, Scott. People, work all their life and they think I'll put away money and I'll be in a lower tax bracket in retirement. But in retirement, most people have their house paid off, so that they lose that interest deduction on their mortgage. The kids hopefully have moved away and they can't write the children off. And of course, if your children are still living with you, they're too old to write them off anyway. So they lose a lot of tax deductions, but yet they still get income. They get their pension income, or they're taking money from their IRA, maybe Social Security, interest, dividends, and capital gains. So it all adds up without many tax deductions. So they're still, paying tax at a higher tax bracket than they thought.
When somebody retires, then now they access their retirement accounts, and that's really how the government gets paid back with taxation. How do you minimize that tax liability?
IRAs and 401ks are a tax postponement plan. So you're postponing the tax on the money you put in and all the interest you've earned. So when you touch that money, you now have to pay taxes. So some of the strategies that we use are, we don't always delay till 70 and a half. People, even if they don't need the required minimum distribution before age 70, a lot of times it's better to take it out early, start stripping that IRA down at a lower tax bracket, so that when you maybe start getting Social Security, maybe that's not added to as much of an RMD. So definitely there are strategies between the time you retire and age 70 and a half when you have to start taking RMDs and when maybe your Social Security is postponed to. So definitely things that people need to look at retirement or even before retirement.
Darcy, finally, talk about how you position a portfolio in retirement to be the most tax efficient.
Just like you manage risks, you've got to manage tax. And when we look at a portfolio of savings or money, we like our clients to put it in 3 buckets. So for tax purposes, we know what money is in the taxable bucket. So that's any money that earns interest, like CDs, mutual funds, stocks and bonds, that's taxable. Then we have a tax deferred bucket. That could be your 401k or your IRAs or even some annuities. And then we have a tax-free bucket. That's anything that's been converted to a Roth IRA or money that was put into a Roth. And also certain life insurance strategies that are under IRS code called a non-MEC. Those strategies allow for tax-free income. So we need to have the right amount of money, the right amount percentage-wise in each of those 3 buckets. And then when we take money out in retirement, we want to make sure we pull the right amount of money out of each bucket at different times to pay a lot less tax potentially.
Darcy, thanks again.
Well, thanks for having me, Scott.
My guest has been Darcy Bergen in Peoria, Arizona. This is Retirement News Online. Thanks for watching.